I'm going to talk to you about how the FX market worked, what the fixes were and how they were set, and how traders attempted to manipulate the FX fixes. These slides need to be viewed in context. We have imposed penalties on these firms for systems and controls failures. Those failures made the misconduct by traders possible. As you can see on this slide, the FX market is absolutely massive. The daily average volume turnover of the global FX market was over $5 trillion in April 2013, according to the Bank for International Settlements 2013 survey. And to put this in perspective, you can see on the right how the size of this market compares with a few other key markets on a daily basis. The global bond market, $272 billion, the global equities market, $216 billion, and the New York Stock Exchange, $49 billion. The word fix is market speak for an FX benchmark. In these cases, we are talking about two of the most widely referenced fixes, the 4 p.m. WM Reuters fix, or WMR, and the 1:15 p.m. ECB fix, which are fixed in two different ways. WMR fixes happen throughout the day, but the most widely used is the 4 p.m. fix. The 4 p.m. WMR fix is calculated by reference to trading activity during a 1-minute window or fix period, 30 seconds before and 30 seconds after 4 p.m. The 4 p.m. WMR fix rates are then published shortly thereafter. This diagram gives a hypothetical example of what the WMR fix might look like, where the purple shaded area represents the 1-minute fix period and the blue line represents the trading. The ECB fix is different because it is a snapshot of the market at a moment in time, which is 1:15 p.m, and this is what the diagram shows, that instead of having a fixed period, we have a single point in time. Why do people want to trade at the fixed price? The Financial Stability Board's September 2014 report on FX benchmarks said that asset and other money managers want to ensure that their FX trades are executed at the same price as the fix. That eliminates any tracking error. Prior to a fix, clients often place orders with a firm to buy or sell at a specified volume of a currency pair at the fixed rate. Obviously, at that time, the future fixed rate is unknown. By agreeing to transact with clients at a fixed rate that is yet to be determined, the firm is exposed to rate movements at the fix. So as you can see here, the risk passes to the firm. A firm will typically buy or sell currency in order to manage this risk, for example by trading in the market or netting off, for example where a firm has a buying interest for the fix and trades with a market participant which has a selling interest. So in this example, the client wants to buy a currency pair and the firm is agreeing to sell that quantity of the currency pair to the client at the fixed rate. What this means in practice is that the firm with this buy order will make a profit if the average rate at which it buys the currency in the market is lower than the fixed rate at which it sells to its clients. There is nothing wrong with a firm which is legitimately managing its risk, making a profit through trading at the fix. One of the issues in this case is lack of control over the chat rooms used by traders. Many firms have now imposed restrictions or outright bans on the use of chat rooms in certain circumstances. Traders use chat rooms to share information about the fix orders, to determine their trading strategies, and to attempt to manipulate the fix. This slide gives you a flavour of what these chats were like. Have a look at the blue boxes, which are some of the names the traders used to describe themselves: the players, A team, One team, and the Three Musketeers. Then look at the yellow boxes and how the members of the chat rooms described how they operated. A three-way relationship built on immense trust. Don't want other numpties in the market to know, but not only that, is he going to protect us like we protect each other? How can I make free money with no heads up? Cheers for saying you were same way, helped me go early. I'd prefer we join forces. Perfect, let's do this, let's double team 'em. Each of the final notices has a worked trading example in it of behaviour around the fix which was able to happen because of the firm's inadequate controls over its G10 spot FX voice trading business. We have prepared some slides which demonstrate this visually using the material from the notices, which we think helps make it clearer what was going on. An example of JPMorgan's involvement in this behaviour occurred on one day within the relevant period when JPMorgan attempted to manipulate the WMR fix in the euro-dollar currency pair. On this day, JPMorgan had net buy orders at the fix, which meant that it would benefit if it was able to move the WMR fix rate upwards. Remember that the WMR fix is set based on trading during a 1-minute fix window. Because JPMorgan is a buyer, it will benefit if it can move the fix rate up. Let's look at what the traders were saying to each other ahead of the fix. JPMorgan has net buy orders for €105 million. It offers to transfer its net buy orders to Firm A. Firm A says maybe. It has a buy order for a top account for €150 million at the fix. Firm A suggests, I'd prefer we join forces. JPMorgan responds, perfect, let's do this, let's double team 'em. Firm A replies, yes. JPMorgan tells Firm A that it has increased its total buy orders. This is an example of building. JPMorgan's building with third parties outside the chat room effectively increased the volume of orders held by them in the desired direction. The more you have to trade in the fix window, the greater your potential influence on the fix. Firm A is monitoring activity in relation to the forthcoming fix in the interdealer broker market. I got the bookies covered. Because JPMorgan is a buyer, it will benefit if it can move the fix rate up. The chances of success would be improved if JPMorgan and the other firm shared information. Since JPMorgan and Firm A each needed to buy euros at the fix, each would profit to the extent that the fix rate at which it sold euros was higher than the average rate at which it bought euros in the market. This graph is a hypothetical example demonstrating this. The blue line shows where the market is trading. The green dots show JPMorgan's trades, the green dotted line shows JPMorgan's average price, and the dotted purple line is the fix price. The gap between the fix price and JPMorgan's average price represents JPMorgan's profit. JPMorgan built the volume of euro that it needed to buy for the fix to a total of approximately €278 million via a series of transactions with market participants. Firm A had net buy orders associated with its client fix orders of €170 million in the period leading up to the fix. It increased this amount, or built, by €70 million. In the last 8 minutes before the fix window, JPMorgan and Firm A bought euros on the EBS trading platform. In particular, JPMorgan bought €57 million in the last 2 minutes. These early trades were designed to take advantage of the expected upward movement in the fix rate following the discussions within the chat room described above. During the 60-second fix window, JPMorgan bought a total of €134 million and Firm A bought €125 million. Between them, they accounted for 41% of the volume of euro-dollar bought during the fix window. The rate prevailing on EBS at the start of the FX window was 1.3957. Over the course of the window period, the rate rose, and WM Reuters subsequently published the fix rate for euro-dollar at 1.39605. Let's see what they had to say after the fix. Firm A says, small rumour, we haven't lost it. JPMorgan responds, we do dollar. The following day, Firm A says to Firm B, a firm which was a member of the same chat room but had not participated the previous day, we were epic at the fix, yes. Firm B responds, yeah. Firm A adds, I dragged JPMorgan in, we covered all the bases between us. Firm B comments, so couldn't have been that shit a week. JPMorgan's trading in euro-dollar in this example generated a profit of approximately $33,000.